Is multifamily dead? Well, that's the question today. Welcome to the Gray Report. I'm your host, Spencer Gray. Every single week, we're trying to break down the latest multifamily research reports, but also covering commercial real estate, the macroeconomy, anything that touches housing, could try and help you make some better investing decisions. Or if you're somebody that's working in the multifamily industry, kind of give you some insight of what is going on in the industry itself. Thanks for taking time out of your day, spend it with us. We've got some important topics to talk about. Like I said, we're going to be examining and asking the question, is multifamily dead? Is the investment thesis no more? Because there is a lot of pain that's going on. Now, if you are an investor of deals that have been going on for decades, maybe you're not feeling the pain, but there's a lot of folks that invested in deals, especially in 2021, 2022, especially in the Sun Belt, that are seeing their entire equity wiped out. And it's not always what you're seeing kind of in social media and elsewhere, but we're in a much different market now than we were a couple of years ago. And I may make the argument that maybe this is a more exciting time in multifamily than it was a couple of years ago, although the underwriting may have said the exact opposite. So we're going to dig into that today. But we also have some research reports that get us a good sense of kind of where we are. Yardi's got a new one out for the summer of 2026. We also have a piece from RentCafe talking about $1,500 of a rent budget. How much apartment space are you actually going to get in 200 U.S. cities? It's going to be really interesting. Also, going to be talking about the latest multifamily investment opportunity from Gray Capital. It's in Indiana, West Lafayette. It's called Century. We're really excited about it. It's the second deal we've brought to market here in 2026. Excited to share that with you here in a little bit. So strap in. We've got a great episode. Griffin's locked in. He's so excited that he doesn't have to do the intro last week. And Blake and Katrina knocked it out of the park last week. Blake and Griffin were holding down the fort the week prior. I am back as I was, reporting live on location on assignment somewhere over in Europe. I don't know. But I'm really happy to be back in the good old United States of America. Let's get into this latest episode. Let's lock in. Let's do it. Let's go. All right, welcome back to the Gray Report. Griffin, thanks for hosting, man. Great job. I hear rave reviews. I haven't watched the whole episode. I'm catching up. It's in my feed. I've seen all the clips, how most people experience most things these days. But how was it?
I thought it was a great time.
Tell me about the conversation with Katrina.
Yeah, Katrina, massive value add to the conversation with Blake and I. 2 weeks ago, it's just Blake and I in here talking about raising money and communicating with investors, whether it's during a whole period or prior to or in the midst of a fundraise, but then to bring Katrina in to talk about what happens once we put the asset kind of into our portfolio and the asset takeover. That, let's just call it 5 to 7 years in between our investors funding their commitment to making their investment to the full cycle exit and the realization of any gains. That's an immense amount of time, 5 to 7 years. What happens in that 5 to 7 years that can really drive returns? And so she was
somebody's got to be operating it. Yeah, somebody's got to be signing leases, fixing toilets.
We asked a lot of Katrina last week to speak for, property management, kind of in general, but then more specifically hone in on Gray Residential, on how she commands her teams and deploys them into different markets. We talked about entering into 2 new markets in the span of about 2 months as we're getting ready to close on Fairmont, Columbus, versus putting the Century and West Lafayette under contract. So it was an exciting kind of perspective to hear from her on, what changes, if anything, versus what ramps up when we do enter into a market where we're establishing our initial footprint. And then we also just kind of discussed with her some of the leadership strategies that she implements, whether it's here at corporate or across her site level teams, to really kind of get our property management teams and staff to buy into the business plan that we present to our investors when they make that initial decision to allocate their funds into a multifamily project. We obviously put together a business plan, and then she needs to put the right team together to deploy that business plan and act on it. So we just kind of asked her what strategies she's implementing, and then we kind of got to know Katrina, I think, a little bit better, which is always fun. So it was a good 2 weeks, but you're correct. A lot of weight off my shoulders without having to do the intro. It takes me a couple of takes. You're just such a natural.
You're too hard on yourself. You do a great job. And then Katrina, she's our senior vice president Gray Residential, our property management arm here at Gray Capital. And he said, yeah, it's nice to hear from the folks that are actually getting things done and are executing. We, the Gray Capital team, we're going in, finding the deals, underwriting, putting the deal together, raising the capital, and still doing the kind of the asset management, but the actual day-to-day operations, signing leases, taking care of work orders, capex, preventative maintenance, fixing ACs. I mean, it's 103 degrees outside here in Indianapolis.
Right. Yeah.
I mean, we will be ACs will be going down, and we have to get those fixed. And so that's not in the business plan. I mean, it is. I mean, it's a line item, capex and HVAC repair, but it's got to get done. And so that's a unique insight that I don't think you always see on every multifamily podcast. It's usually talking about, whether it's raising capital like you guys talked about, or it's finding deals, or, doing your first deal or something like that. Or the market, macro. We talk about macro stuff. It's nice to get actually kind of micro, boots on the ground.
We're talking about all the stuff that kind of, informs decisions, but we're not talking about the people that are, getting their hands dirty and implementing those decisions on a daily basis. So.
And by the way, Katrina actually has her own podcast called The Complex. She's actually going to record an episode after us. And it's hosted wherever you can get podcasts, but also on the same YouTube channel, the Gray Capital YouTube channel. Again, if you're interested in the property management and the operation side of things, highly recommend checking that out. Well, let's get into it. And we're going to talk about, again, is multifamily dead right now, the bear case, the bull case, because there's a lot of folks that are going through a lot of pain. They're losing money. But before we do that, and this is a little bit of foreshadowing, but I want to talk about our latest deal.
Right.
Century Apartments. It's located in West Lafayette, Indiana. And to do that, I'd love to just, we have this cool interactive deal room, which if you go to dealroom.graycapitalllc.com. You can get access to this page. Just go to graycapitalllc.com. You can just jump right in here. It's really good. It's kind of like the first of its kind. We launched it for our last deal, Fairmont Apartments, that is currently, we have a wait list that's open. It's fully subscribed. Should be closing here in the next couple of weeks. Excited to do that. But Century up in West Lafayette, it's a very similar thesis, different market completely, but some very similar drivers, a little bit of a different return profile. As you can see, Fairmont here, 14.3% projected IRR, 2.21x like target equity multiple, 8.5% average cash on cash. Where Century, it's a little more tilted, the return profile is tilted a little bit more towards total return. 15.1% projected IRR, 2.4x equity multiple, and around an 8% cash on cash. So it's a little bit more total return focus rather than cash flow focus, although the cash flow is good either way. All right, once you get into the deal room, again, one of the cool things is we've got this whole chat interface. It works. It's powered by an LLM. You can ask it all kinds of questions about, projected returns. You can ask it about Gray Capital. You can ask anything about the deal, and you can stress test it. And so one thing that's really exciting that investors have been doing is they've been like absolutely grilling the deal, like really like where does the deal fail? What are the risks?
I think just some of these investors have been communicating to Blake and I. They just get in here. They're basically testing the downside risk here, and basically how we're setting the deal up to protect against the downside, but trying to break the deal, trying to basically just kind of let it crumble at its foundation.
Yeah,
and this LLM's been giving what I think is very thoughtful, detailed responses.
Yeah.
Sometimes
it's all trained on the actual deal information, Gray Capital. And it's not sugarcoating anything. I mean, it may show the upside as well as the downside, but I mean, it's going to give you kind of straight, kind of the full story. And it's going to allow you to schedule a meeting with Blake and Griffin and the team, asking some questions. So check out the deal room right now. But again, just learning about Century a little bit. What's exciting, what's happening at West Lafayette, is that there is a massive opportunity with SK Hynix is building a $3.8 billion dynamic random access memory packaging facility. And so this is the RAM, the memory that's going into all these NVIDIA chips and what's needed for the compute to power all of this AI infrastructure build out. All these data centers need SK Hynix DRAM chips. And that is literally going in right across the street from Century. Now, Century is also down the road from Purdue University. It's located in West Lafayette. And it's also inside the Purdue Research Park. It's the only multifamily community inside the research park. And I was actually looking. We're in due diligence right now. I'm on Century, and we're doing our due diligence. It's so different than we were able to do last year because we have all these AI tools, and we were able to negotiate access into the property management system and to allow our AI agents into that system to be able to extract reports. And so it's being able to do a much more thorough job of scraping, downloading. And in the past, what we would have to do is request individual reports. Well, I may not know the names of all your reports that you even have or what you have access to. And so, it's kind of like doing discovery without getting everything. But by getting into the system, we were able to extract every single report. So I was looking at the demographic report, which I'm probably going to put some sort of infographic together on to highlight the employers of residents at the live at Century. Now, there are some students, mostly grad students, a lot of international students, but the employers are it's all SK hynix, it's Boeing, it's Rolls Royce, it's like the Japanese National Defense Force. It's all these high tech and really interesting employers because it's inside of this research park that is almost adjacent to Purdue University, which is one of the top engineering schools in the entire country.
We've been having these initial conversations about Century and West Lafayette, and we're very excited about the potential for SK hynix, but I think the one thing that I keep kind of leaning back on, Spencer, is its location inside the research park. There's 250 companies that work out of this research park that are all in walkable distance that employ, I think it's almost 6,000 employees just right there within walking distance of Century. So it's right there at the doorstep of the asset. The jobs are already there. The employees are already there. They need a place to live. And they're already living at Century. And there's more of these high-paying tech jobs that are coming with the SK hynix delivery. Also, what we haven't mentioned yet on the podcast is there's those two hospitals, specifically the Parkview Hospital, $200 million construction project going on right across the street from Century. So not only will there also be tech, but there'll also be that healthcare component. That, to me, really is a signal of longevity within the area and kind of some staying power for Century.
Yeah, no, it's a good balance. You got the healthcare, you got education, and then you got kind of high tech jobs that are all high paying.
Right.
And we're at this period of where there's been some supply that's been added to the West Lafayette market, but we're starting to see getting over that hump. And as that supply declines, it's going to be right at the same time that all these jobs are delivering. And I think they're estimating around 700 jobs just from SK hynix. I forget how many on the Parkview Hospital, and then you have the new IU Health Hospital. It's also being built just about a mile. Less than a mile down the road. So it's kind of at this epicenter, the top public school district in the entire state of Indiana. Also is where Century is.
Right.
And SK hynix is bringing folks over from Korea every week. I think we were doing due diligence on site last week. The next day they were hosting a big event for SK hynix employees.
Yeah, come and tour and check out the community.
So it's in an environment where you're not sure where kind of the growth is going to come from. There's conversations about what AI is going to do to jobs, which right now looks like we're creating more jobs related to AI than we're really replacing jobs. But regardless, even if you fully read into the AI is going to replace a lot of jobs theory, you still are going to need engineers and people doing the math and actually building the chips because we don't have the robots to do all of that yet.
Right.
Those engineers are the ones that are still going to be around that we're going to need.
There's been some comments and some conversations made here internally, but also from external LPs about the kind of the speculative development of that SK hynix facility. Take a look at the investment overview, investment preview within the deal room. We've got a great video, a drone shot that kind of goes over. There's cranes, they're moving dirt. This project's happening. Yeah. And if I remember correctly, I think even SK hynix has mentioned a potential already need for some additional space in regards to a phase 2 to their development. Now that I think can be speculative because at this point in time it's just an announcement.
I don't think it's been confirmed, but I've heard the same. There's rumored to do a second.
But I think it just shows that they're there for a reason. SK hynix, they're there to have access to the 3,000 engineers that graduate from Purdue each year. They selected that site very specifically. And so I think that the staying power of both the hospitals and that SK hynix really does lend what could be a promising future for the Century.
No, I agree.
What's your favorite component of the Century, Spencer? I know we did the Fairmont deal, also had some of that Intel plant, kind of tech fabrication, manufacturing, immediately adjacent. This one's very similar.
The adjacency, I think, is what's really exciting, because for Fairmont, obviously we're in it's Columbus MSA, kind of New Albany, kind of or Westerville kind of submarket, which is really close to the Intel plant. But you've got some competition around it. I mean, it's not far. It's like a 10, 12-minute drive.
Yeah.
But like this is like immediate adjacency, to the site, to the SK Hynix, Neuro project, which is what they're calling this memory fab facility. Yeah. But then again, you're in the park as well. You're in the research park. And so just if you want to live close, and again, there is some new construction that's being built like on the other side of the SK Hynix facility, but they're coming out with higher rents. And what I've been told is their rents are actually outside of the like allotted rent budget that SK Hynix is being allocated. So their employees are like being given like
a subsidy a little bit.
Like a subsidy of like, hey, here's your your what you're being allocated for rent. And Century like slots right in because it was right next door when they were kind of figuring out. So, but the other two, the newer deals, which are more expensive, and they're nice, but again, Century's only 6 years old. It's essentially brand new. So these are a little bit newer. They're more expensive, and they're a little bit out of the budget. Now, an SK Hynix employee, they're going to have plenty of money. If they want to live there, they can spend the money they can. I mean, many
that first 18 months that they're in town, you don't know where to live. You got to get there quickly and get situated and settled. 18, 24 months, potentially the Century kind of is the answer.
And there's already an established relationship.
Right.
The employees are already living there. I was going through, again, the rent roll and the employer list today. It's a lot of SK Hynix and SK Hynix construction entity.
The other thing that I thought was cool is if you jump into the Purdue Research Park website, they funnel anybody that's looking to either gain employment within the park and or establish their business in the park. They funnel you to the Century homepage as a preferred housing provider.
Yeah. Well, here's that picture that the Griffin that you took. You said you made a version with Gemini that made the sky a little bluer. But so I'm just immediately to the left of this picture is where the actual park is. And this little sidewalk here on the west side of the property kind of goes around and connects to the park itself. But immediately adjacent to the northwest, or the northeast, that's it. That's the Neuron project right there. That is where SK Hynix is building their facility. You also have Anduril, which has a facility right here, and you have the Indiana Manufacturing Institute has a nice facility right there as well. And then the Parkview Hospital, as you mentioned, Griffin is going in across the street a little bit to the left. And IU Health is going down just a little bit further to the north there, down that road. So it's exciting. But just taking a look at a couple more pictures. I mean, again, this is, and there's 3 bedrooms. This is, it's near Purdue, but it's not built as student. It's built as market rate. There's 3-bedroom units. It's not rented out by the bed. It's rented out, by the unit itself. There are some grad students that live there, but it's got all the amenities you want. We're also going to bring in around $800,000 to do some exterior, just improvements, some like amenity upgrades, just some touch-ups, just to make sure we're as competitive as possible. And again, hop in the deal room. It's interactive. You can adjust your investment amount, what your ownership would be estimated. You can go through different stress tests, do some analysis, and breaks down your return. You can do some tax estimation. Again, this is all an estimate. You consult your own advisors. And then also takes you through the risks of the deal. What happens if we're in a soft market scenario? What could happen? What are the different risk factors? Again, you can read all about this, even more on the PPM. And then this is my favorite, is the advanced analytics. And this is where we go really deep on some of these new AI tools. We use a multi-agent adversarial simulation study paradigm that we've developed, that we run thousands of simulations through different scenarios and track all of those outcomes, and look at the probabilities. And we essentially have different agents debate and argue the merits of the deal and the different assumptions, and kind of give like go or no go calls. And pretty much it was a go across the board, except for like the extreme bear case. The agent was a conditional go, and it was basically just saying that SK Hynix had some major issues, and also some concerns about the supply in the area. But check it out. It's exciting to go through, and it's a lot more than a sensitivity analysis.
Right.
What I love about this deal also, and again, the sensitivity analysis kind of explains some of it, is it's a very hard deal to break. And we're assuming low. We're basically assuming 0.75% rent growth year one, maybe I think 2% rent growth by year two, average of like 2.8% rent growth over the whole period. So like below average rent growth, from a historical. While we're still putting money into the deal, we're improving it, and all these jobs are kind of come in. It's almost like we're just underwriting like a bad recovery in the market without any new jobs. But in reality, there's going to be potentially thousands of new jobs that are coming in the immediate area. So it's exciting. Griffin, you, Aiden, Blake has done a lot of great work on the deck, the deal room. It's been exciting. Yeah. So the bear stress tester gave it a conditional yes.
You had put a LinkedIn post up maybe, 10 days ago, 2 weeks ago about, operators leading with their return metrics when they're discussing an investment opportunity. We haven't gotten to those while we talk about Century, because I do think that the business plan and our ability to achieve it far outweighs, any attractive returns on paper. The story, I think, fits somewhere in between that business plan and the returns. The one thing I think that I've seen LPs get excited about the Century, especially after Fairmont, is that just single, carry or promote split of that 80-20 LP-GP, which I think is better than market. It's above market trend, which is usually at 70-30. But I've seen a lot of investors' eyes kind of light up when there's not that secondary hurdle on the back end once we're able to achieve that 8% pref and return originally invested capital. I think that's a massive differentiator here in the Century comparative to what I've seen other operators push out. Sometimes there's several different hurdles or GP catch-ups that are involved. There's no catch-up. There's only one single hurdle. Try to keep the structure very simple here. But the returns are also what I think is very palatable and also attractive, specifically the cash flow. We've seen the last two deals we've done be a little bit healthier in the cash flow than we've seen historically. And I know that gets us excited here at Gray Capital. It's kind of our basis of our investment thesis and foundation is just, kind of cash flow first, depreciation second. And that's just kind of how the Midwest works. So I guess the question is kind of lead us into the next segment. We read a LinkedIn post earlier that was potentially a moratorium on multifamily asset class or, starting to dig the grave for multifamily investments. I think it's apparent to us, at least in the Midwestern markets, that multifamily is not dead. But this gentleman was raising the question of, is multifamily dead?
Yeah, well, and I don't think that he was. I think that's the good question. I think that's a big question on people's mind is, you hear a lot about capital calls and people losing money. And it's, people asking the question, okay, was, the multifamily investment thesis, dead. And Brian Briscoe, who I have a lot of respect for, and he's been on the podcast. I've been on his podcast a couple years ago. But I've followed Brian for a while. He's based out of Salt Lake City, and he syndicates and has a multifamily company. Also, I think like a mastermind group as well. Cool. Does some multifamily education. And I thought he made a really interesting post. And I think everyone comes at it from a different perspective. And he's basically saying, hey, look, the way people are portraying multifamily in social media is completely backwards, and saying, here are people say that all the benefits of multifamily and they're doing all these deals and everything's fine. He's like, that's not always the truth. And I think his experience and some of the experience of other operators and investors is also different from, I think, our experience and Gray Capital's experience. And that's not to say that Gray Capital is better or so special. I mean, I think we are special, and I think we are well above average. And I think there's a lot of things that show for it. But there's a lot of really good operators.
Yeah.
I think I'll say there's a lot of really good operators that are losing money right now. And Brian is really being transparent and talking about how he's losing money and how it's not been fun and just the reality on the ground. And Griffin, you've had a lot of conversations with LPs, some of our own LPs who have gotten into deals that aren't working out over the last kind of year and a half or 2 years that are really struggled. People have either been diluted or they've truly lost money. And so he's some quotes here, and I don't know if these are paraphrased or these are actual quotes, but from a family office principal, we just had another multifamily deal lose 100% of the equity, $20 million this time, just foreclosed yesterday. Another 30-year real estate vet. It's messy as F out there. It's contagious. The property next to ours dropped their rents to prevent foreclosure, so now we have to drop ours too. Then we got a predatory private equity dude. Who knows who that is? You'd be surprised how many of the big name operators I'm associated with are losing money. Then a multifamily loan broker, everyone's looking for a refinance, but we can't make any of the numbers work. Same broker lenders have to work with people that have had foreclosures, or they wouldn't have anyone to work with. Fund manager with tens of millions invested. We've only had one complete loss, but several more are coming. But he said, here's the contrast. Here on social media, this is where he tends to see this is where everyone else is losing money, and we do things the right way. And then people saying like, don't do this, do that. They're losing money because of blank. You can't be sure that I don't do that anymore. Your investment is safe with me. Random social media influencer says you should never invest in social media influencers, especially the ones with long, gorgeous beards. I don't know who has the beard. Mine's not long. I don't think he's talking about me. In fact, if you watch the deal preview video, I shaved.
Yeah, I didn't recognize that guy in that video.
I know, right?
Thought maybe there was an imposter in the office.
Okay, if you want to see a different version of what I look like without a beard, you can watch the deal preview video, which is on the deal room. So it's not fun. Brian's basically saying he's getting ready. He lost a deal this year. Went wrong. He's saying Brian was a Marine, 20 years in the military. And he said this has been more stressful than any period of time in the military, including his times in combat or his combat deployments.
There's a different weight to putting other people's money to work.
Yeah.
Risking other people's money and being in charge of the outcome. I think that
it's a lot of responsibility.
There's a lot of responsibility. I think you know that better than anybody.
Yeah.
I think that's at the forefront of Gray Capital, and when you started this company and just offering that investment to what was friends and family to start, and then kind of
it was just me. It was just me and my brother, and then me, my brother, and my dad.
Yeah,
and obviously Alex
grew to aunts and uncles and next door neighbors, and then you got the stranger from Illinois that jumped in. Whoever, they just grew, and all of a sudden now you're managing millions of equity, hundreds of millions of equity at this point.
Yeah.
It's a pretty immense amount of weight that you have to carry through this downturn in the market. I think it's just kind of obviously it really is the center point of our investment thesis of wealth preservation and conservation. But it's not that easy to do that, especially in times like these.
Yeah.
So I can certainly understand why he's stressed. Absolutely. I also appreciate kind of some of the candor that he showed here in regards to just kind of being out there. And like you said, social media, you get on Instagram, Facebook, you name the outlet. It's what everybody wants you to see, and none of what they don't. And so it's you have to kind of read some of these posts with an idea of they're just sugarcoating this, and this post is not sugarcoated at all.
No.
It's very real.
What do you think? I guess how much of this resonates is it's all true. How much of this resonates, with you and some of the conversations we've had with investors and then but then also we haven't lost any investor capital, and we don't have any deals where that's something that we see as highly likely. At all. Not that things could happen. Again, things could happen that are beyond our control. We could really screw up. We could make a bad call. So when you, what's the difference? This is the brag, because again, I don't think it's necessarily. Right. So, there's some incredible operators, and everyone was assuming interest rates would not rise as high as they did, and no one was assuming that rates would stay as high as they have been, nor was anyone forecasting, any economist, anyone in the industry was projecting slow rent growth and negative rent growth in most of the country, especially in the Sun Belt, that everyone was underwriting explosive rent growth. And so the variance so massive in the Sun Belt. The only way that they made deals work is 7 to 10+% rent growth.
Right.
Thinking that okay, here's a comp up here because someone like listed something on apartments.com. They never actually leased any apartments, and it was, the rent was up here, so they did their whole pro forma was going to get up there, and they're going to grow from there, and then they're going to sell it at a 4.5 cap.
Yep.
In a couple of years. Well, just that the numbers don't work at all. Now, there's a lot of nuance in all of this.
Mm-hmm.
Right? So, and what do you think from your conversations, Griffin?
Well, so this is what I tell the LPs about Gray Capital and how we operate. I think first and foremost, we invest alongside you, right? So we have that GP co-invest. We are putting real Gray Capital, Gray family dollars to work in the same project. We are, I think, fortunately well capitalized, and so when we go out and buy a deal,
but would that have but would any of that have mattered? I mean, other than maybe the deal selection.
I think it's about how you and Alex and your family approach investing into real assets. You guys are not out there chasing yield. You're not out there, trying to get a deal done because you have to get it done. It's hyper selective. It's hyper disciplined, and patient with long term horizons. And so, I mean, truly, by the time your first foot hits the door, when you step into the Gray Capital ecosystem, it's 100% about risk mitigation at the entry, and all of the rest really not going to take care of itself. But if we can buy right up front, finance right up front, and put together a business plan that is actually achievable instead of trying to believe in a story that might work, I think all of a sudden you produce results that you can be proud of. And not every project that we bought in the last 5 years is going to produce a 25 to 30% IRR like our track record. Yeah. But what they are is they're currently distributing. They have no rate risk or loan maturities, and they're I would say fairly well occupied in an environment that is really soft in regards to
most of them, not
all of them, but most of them. And so I think it's that approach that you guys are taking of like, look, we could go out, we could take a little bit more risk, and we might make a little bit more money on the back end. But I think the really important thing about investing with Gray Capital is how you guys have taken the approach of like, we're not trying to get rich quick here. We're trying to compound growth over a long term. Yeah. And not that everybody's out there trying to get rich quick, but I think there's a lot of people that eyes got really big, like you're mentioning, when you can underwrite 10% rent growth or 7% rent growth or whatever it might be in markets that otherwise now have negative rent growth, and it's just kind of upside down. So the conversations with investors and trying to kind of, again, earn their trust is depicting to them our current portfolio, its health currently in today's market conditions, and how it still is immensely healthy comparative to some of the things that you're seeing on the internet or in the headlines.
I think a lot of it is it's not it's less about getting excited about the upside. It's more about being comfortable with like the downside.
Sure.
And being comfortable with if everything doesn't work out. Okay, we don't. This doesn't happen. That doesn't happen. We're not able to achieve this. This is what the return looks like in that scenario, and it's not going to be exciting. But are we okay with that? And are we comfortable with that outcome? And so like a lot of times it's like, okay, well, I don't want it to be a 9% IRR, but if all of these things happen and we still can get basically a 9% time-weighted return over the whole period. That's a lot better than a stick in the eye, as they say.
Yeah, sure is.
It's a lot better than a complete loss. It's a lot better than a capital call and then a complete wipeout of equity.
Okay, totally agree. I've been putting together just like email sequences in regards to lead nurturing here at Gray Capital, and I wrote one last week that basically is kind of telling a story of like what makes a good multifamily deal. And this is a five email sequence that essentially just has categories. And if you're listening, hopefully you get some of these. I think they're great. But this one specifically is talking about the business plan and not getting too stuck on this hypothetical story of what ifs on the upside. And there's 3 bullet points in this email that basically just says what makes a good multifamily deal. The first bullet point is investing with assumptions that you would bet your own money on. So I feel like that skin in the game, that 10% to 15% co-invest that Gray Capital has, we're doing that. We're underwriting our projects with assumptions that we're willing to bet our own money on. I think that's largely important. The second one that I put in there is, basically a plan that you can execute is going to beat a story that you have to, sell or believe. And part of that is implementing a business plan that creates value, and it's not implementing value that you're simply hoping for. So actually truly creating some value. And then the very last thing is that business plan has to survive the downturns in the market or soft markets. And I think the way that we underwrite with our assumptions that we're willing to bet our own money on, all of this comes together in our underwriting and our business strategy, business plan, and all of a sudden we've got an asset that's durable and it's still cash flowing and distributing and can withstand some of these rough waters and softer markets. So that's the way that I kind of describe it. It might be a little bit long-winded, but
no, that all resonates. Especially adding value, not extracting value, but like really truly adding value that matters. And that can be harder to do on when you're buying a newer asset. Fairmont, admittedly, we're not doing a lot of. There's really no kind of value add. There's an operational play. We're going to operate it better. We're going to operate it a different way. We're dropping in kind of the gray res tech stack and our team and all that, centralized leasing.
Yeah.
And we're building a monument sign, but there's literally no ROI. Not just there's no ROI, it's just that it's new, brand new construction. It has every amenity imaginable. There's no other amenity to add. There's no upgrade that makes sense that is in demand by the market. So it's more of an operational value add play. But Century though, we looked at it, but in all the deals. It's what can we do better? How do we leave it in a better position than when we acquired it? For obviously, investors, but residents.
Right.
If the residents think so, that's going to be more renewals, more leases, and investors are going to be happy as well, as long as we keep it all within budget. But Century, we looked at it and we're like, this is great, but could it be a little bit better? And there's some new construction going down the street. How do we be competitive with that? How do we make this look even a little bit more modern? There's parts of it that we were like, this kind of reminds us of student housing a little bit. I think when they built this, it was market rate, but there was a little bit of there was kind of a lean towards the student side because the SK hynix thing didn't exist yet, and the research park was brand new. And so we're like, well, how do we move away from student and really leaning into more of that, the higher paid, educated, workforce. And so making a little more, cleaner, a little minimalistic, but also how do we make it appeal to the folks that are moving in from South Korea that are going to be living here? I can read the rent roll. There's a lot of folks that are from Korea that already live there. There's going to be more folks that are from Korea. Now we're going to make it just a place for everyone from South Korea to live, but we should know who our market is and our demographic, and we're going to make it great for everybody.
Right.
How do we make people feel at home? Welcome to America.
Yeah, I think that's the other thing too that maybe I can't say that it's different, but I think it's something that we can be proud of when we do buy an asset. Again, I talked a lot with Katrina about this last week about creating sticky residents, and she always is very prideful and gets excited to talk about how we are cultivating communities and not just being landlords and collecting rent. So I think it comes down to good operators find a way to create that community, create connections in your residents so that they want to be there and they're excited to come home and excited to wake up on that property each day, which I don't think is very easy to do. I think it's quite challenging because the folks that are renting can be transient. They're maybe jumping from job to job, or they get a promotion and they all of a sudden think they can go afford a bigger, better, more expensive apartment. How do you keep those people there? I think
it's tough. 50% average turnover at a community, and so in 2 years you got 25% maybe or less of the people that were there a couple of years ago. There's only a few people that are going to stay for past 2 years.
Right.
So how do you have that continuation? It's easier said than done. And also on the employment side, property management side, there's a lot of turnover in the industry, and so you got residents that are turning over, you have staff that's turning over. How do you have that continuum, that that sense of community? It's always an aspirational goal that we're always are working on, but it can be tough because you have to have that kind of that buy-in across the board. But I think if you have the mindset of this is what we're going to do and set out to do, as opposed to settling with everyone's transitory and everyone will be here tomorrow, and this is a pure transaction, and it's not going to be someone's home. Well, maybe it's just for a year. but it's still their home for a year. They may be raising their family in that home for a year or several years, or this is maybe their first home that they take an incredible amount of pride in. And again, we don't get it right every time, but I think again, if you at least come into the process with that mindset, you've got a better chance of achieving it than not even making the attempt.
Yeah, I think it's a small variable in this larger equation of foreclosures, forced sales. But I think creating a community leads to stickier residents, showing the value of a 3% rent bump year over year, making people want to stay. It's a small variable in the equation of not having to give the keys back to the bank. It's a small variable in producing distributable cash flow to our investors. But I think at the end of the day, there's all sorts of stuff that could go wrong. But if you can genuinely create a community, occupancy, rent bumps, collections, I think all of that is improved by that sense of community. And so I think that's a largely important variable, but I do think it's one of very many.
Yeah, agreed. Well, let's just jump right into this report from Yardi Matrix, U.S. Multifamily Outlook for the summer of 2026. A couple of headlines: inflation roils U.S. economy, the Midwest core metros, top rent gains. What's up? Transaction activity slow to recover. Again, a lot of this is the same, and I think Jeff Adler and Paul Fiorella, friend of the show, do a lot of good work on these reports. I really appreciate the analysis. Again, some of this is starting to sound like Groundhog Day a little bit. Midway through 2026, multifamily is muddling along. Condition likely to persist throughout the end of the year. That's what we called as well. I think we were calling it's basically we've got to get to at least till 2027 until we start seeing some actual momentum. Depending on the market, we're seeing rent growth in some of our markets right now, but there's competition everywhere, even in the Midwest. Uncertainty sums up the economy. My gosh, good luck. As operators placing debt in the market, which we threaded the needle last week on locking in some debt for Fairmont. It was so sweet. And we caught it right when the ship started rolling. Oil was plummeting, rates were plummeting. We locked it in.
Then we went to bed and we woke up.
Yeah, and then it was like, then a ship got hit with a drone, and then we were bombing Iran, they were bombing us on throughout the weekend, and then everything was settled by Monday. It's almost anyway. We're still getting through the supply glut, but again, I think we're starting to see light at the end of the tunnel. Not to reuse a phrase we've said a lot of time on the show.
Look at the last sentence there. I think it's interesting that they're projecting and forecasting out into what would be 2028 for 450,000 units to be delivered versus what was delivered in 25 of 700,000 units.
Yeah, so that's the big long-term story, is that supply is coming down. It's not going to zero; it never will. You always have stuff in the pipeline, but it's a fraction of where it was.
Let's do some on-the-spot math. They say in 25 there was 1/3 compared to the 700,000 units that was brought in 22. So if we're dropping 1/3 from 700,000 in 22, in 2027 they're projecting 450,000. So that's dang near almost 50%.
Yeah,
I'm bad at math.
I'm going to let you do the math in your head on the show.
I walked right into that in front of all of our viewers. I'm not a good mental math guy, but it's close to 50%, maybe 43%, something like that.
It's less. It's a lot less. Property sales are limited by refusal of many sellers to accept current market price. You hear that, sellers? You got to. This is an issue that we've had, and I've had to have some conversations with some folks I really respect. Of just, I don't know if you understand what market you're in. It's not a seller's market anymore. It's a buyer's market. We're buying for cash flow. We're trying to buy close to 6 caps. We're not buying at 5 caps anymore. You're trying to sell at a 4.5 cap. Get out of there. I remember this broker at NMHC. You know who you are. And when I said, and they're like, what are you trying to acquire? What cap rate sounds good? And I was like, I don't know. At least mid 5 cap. 5.5, 5.75. I remember she was like, where are you going to find that? Like offended, like very offended that I would say mid 5 cap, because of course all of her deals are, mid 4 cap.
Right.
And I'm like,
right.
I'm sorry, but like we're trying to be realistic here. We're trying to adjust for risk, and we're trying to create yield, and we're looking at rent growth, we're looking at expense growth, and the reality on the ground. And again, the long term thesis makes a lot of sense, but we can't buy something that's negatively levered and negative cash flow.
Yeah.
We got to get good cash flow year one. That's why we're doing this.
Mm-hmm.
And so I'm sorry that we're not giving you the number that you told that seller. I don't know why you told them that number, but you're living in the past.
Yeah.
And we're trying to at least live in the present, if not the future, a little bit.
Mm-hmm.
And so, they're the sellers, because they don't want you don't want to admit defeat. You don't want to tell your LPs. You want to hold out. You want to think that you have more time, and there's been so much can kicking, extending and pretending, and just we're going to wait a little bit longer. And folks are starting to run out of time. I mean, I was at an acquisitions meeting with Addison and Jay. We did a little acquisitions lunch and talking about what we're just seeing on the market and market conditions. My gosh, I mean, just we're looking at deals that have been on the market for 3 or 4 years that have been floated to us that we've offered on, and like our price has not been going up necessarily. It's either stayed the same or it's gone down.
Yeah.
And but there is, we're starting to see some more capitulation, not all at once, but there's some more capitulation. And so, kind of getting back to Brian's piece of Brian's post on is Multifamily Dead, and it's from the perspective of buying in 2021 or 2022 on a bridge loan with aggressive assumptions, that feels like death. Mm-hmm. But if you look at buying a basis at prices that you can't afford to build it at, and when supply is coming down, and you're seeing an environment where again there's more renters, they're being created more than ever because just homes are too expensive to buy. Mm-hmm. I think it's an exciting time. It's hard to appreciate that when we're around the trough of the market and everything's dark outside and everything seems bad. Mm-hmm. Again, we talk about this all the time, but you buy low and you sell high, and everyone is talking about multifamily, being dead and not working is because their perspective is they bought at the top and they're selling at the bottom, and yet that doesn't feel good.
No.
But that doesn't mean that no one's going to be living in apartments.
Correct.
In fact, a lot of people are going to live in apartments where they want to or not. You need a place to live, and what you can afford is an apartment. A lot of people prefer apartments or like apartments.
Correct. Yeah. The future is rental housing, and that's just the way that it's going. There needs to be, or will have to be, some crazy massive shift in the way that I guess capitalism works, or the United States is functioning, for there not to be this massive demand for rental housing looking forward. So get it. Certain markets are operating in immense headwinds and very challenging conditions, but lengthen your runway here a little bit. Take a long-term view. Housing's essential. Housing's getting more expensive. Rental housing, I think, is the answer. I mean, look at. I hate to throw my little brother under the bus, but he's the only guy that I know that's like just going to be
just toss him.
A lifelong renter, unless all of a sudden, his girlfriend goes out and buys a lottery ticket, and all of a sudden, I'm living in his basement. But there's just nowhere else for my little brother and his girlfriend to live right now. They don't have. The only solution is to rent an apartment.
Yeah.
It's the only place they could move back home and live with my mom, but not for long, because my mom's getting ready to downsize, so they got to rent.
Yeah.
I don't know. I think that the kind of removing the negative lens, or maybe the cloudy lens that this market downturn has kind of placed over the entire, industry and asset class, and just kind of getting ourselves out of this like miserable, trough of the market, and taking a look at what it could look like 5 to 7 years from now. Maybe shorter, maybe longer.
Yeah.
Could potentially look like. And it's like you said before we started the podcast, it's kind of a tough scene out there, but it could be a really, really awesome opportunity to be getting into, or to start investing in multifamily, to be buying into the multifamily asset class, just because of what we talked about earlier. 4.5 caps are nothing straight in a 4.5 cap. We're looking at 6 caps. And then long-term horizons through operations, NOI growth, opportunity to disposition from that asset at, pick your cap rate, but
pick
seems
your
like a good
cap
time to
rate.
be buying.
And then I'm not even on our deals right now. I'm not even looking at total return. I'm looking at cash flow.
Yep.
The IRR is going to be what the IRR is. And pick your cap rate. It's 5.5, 6.5, 7. It just, if the cash flow is good, if we can get average over 8 over 7-10 years, I feel pretty good.
Sign
Closer
you
to
up.
10.
Yeah.
Another thing we talked about earlier, we had a little get together meeting. Folks are looking at real estate as the source of alpha in their portfolio, and I think that's a mistake. Mm-hmm. It can, certainly was in mine over the last couple of years, but it's that's not what it's supposed to be. It's
right.
supposed to be a diversifier. It's supposed to get your portfolio close to that efficient frontier. And it's supposed to be, like a diversifier from the stock market, something mm-hmm. that's not completely uncorrelated, but less correlated to the equities. And it's supposed to be a part of a portfolio. It's why family offices and institutions have real estate, anywhere between kind of 50 and 40% of their portfolio. It's a bedrock cornerstone piece, and how you choose to make that up with risky or non-risky real estate, because just within real estate, again, just doing a short-term bridge loan value add deal in the Sun Belt is very different from a stabilized fixed rate positive levered Midwestern deal. Mm-hmm. It couldn't be more different. But you're not trying to get a 30% IRR. 15% is like more than adequate. If 12% serves its purpose in your portfolio, if you can achieve better than that, I think you're doing a good job. And so I just think that since real estate, whether it's industrial or multifamily, has done so well over the last cycle, people are maintaining those same expectations. And this is why when we have our calls with prospective investors, we tell them pretty early on is you're looking at our track record, and it says an average IRR of full cycle projects of 30, 29, 30 some percent. It's like, that's not going to happen. Like, don't expect that. Don't expect that at all. Like, we're going to hit our 14, 15, 16. And it's going to be great. You're going to get cash flow along the way.
Correct.
And that's just how it is. Okay, one last piece. Check out all these reports. Go to greatcapitalllc.com. Sign up for the newsletter, because not only do we do a podcast, but Griffin puts together the best multifamily newsletter in the industry. It's delivered every Thursday at 8:30 Eastern. It's packed full of all of the latest research reports, articles, all the stuff we cover on the Grow Report, but a lot more, including videos. It's incredible. It's been going since 2020. It's the hallmark, marquee multifamily newsletter that all others imitate. I can think of many newsletters that have copied our straight up format. They just copied our format and they try to do the same thing. It's just not the same. RentCafe did a little piece, $1,500 of a rent budget. How much apartment space can you get in 200 U.S. cities? It's not that much space, people.
No.
$1,500. And the average... Oh my gosh! The average 2-bedroom rent was $850 a couple of years ago. Mm-hmm. So now we're at $1,500. It's a wild ride. But let's bring us in, Griffin. You're an expert.
I threw this in the newsletter last week, solely out of I thought it was interesting. There are 2 regions in the United States where you can effectively get what I think is a healthy amount of square footage for $1,500 a month. That's the Midwest and the Sun Belt, including Texas. And there's 2 kind of different rationales there. Sun Belt oversupply, lots of concessions in the market. That $1,500 might go a long way for the first year, 15, 18, 24 months. But in the Midwest, it's got a whole lot more longevity. So I just thought it was interesting. There was a very cool comparison between regions, states, different metros, primary versus secondary markets. Where does your $1,500 go the farthest in regards to renting an apartment? And you can see the map here. Midwest and the South are kind of the most prolific or most densely populated with some of these opportunities. If you have $1,500 to go and rent an apartment. The one thing that I did also think was super interesting was if you scroll down, Spencer, there's a kind of comparison between a Manhattan, New York apartment for $1,500 and this McAllen, Texas, which you've got to imagine is somewhat saturated in supply, but there's 1,300 square feet versus 210 square feet, all for the same number of dollar bills per month. So it's just kind of a very different stark contrast between different metros or different markets, and how much you can get.
But your rent might be
bang for your
frozen in
buck.
Manhattan.
Your rent might be frozen in Manhattan, but your water also may not work, and you don't have central air, and your window may not open. Who knows? But 210 square feet for $1,500 a month. I would be getting a remote job and moving to McAllen, Texas. So
Man, yeah, it's tight. Affordability is a major driver of where people are moving right now, and like New York has actually seen some rent growth despite some of that rent freeze and rent control. But people are moving to places that they can afford, which makes sense. But there's not a lot of cities out there where you can get a 2-bedroom for $1,500. There are some, but not a lot.
I think Indianapolis is on there for number 35 nationally. You can get just over 1,000 square feet in Indianapolis for at $1,500. And then Fort Wayne, Indiana, about, 60 to 80 minutes northeast of Indianapolis is Fort Wayne. You can get a little bit over 1,100 square feet, and they're number 19 nationally. So, again, we are seeing a lot of demand here in the Midwest, and it's due to, one, the affordability, but we also have this immense amount of kind of growth that's happening in the last 2 to 3 years, and then forward-looking. So not only are our apartments more affordable, but we also have these increased demand drivers. And so you'd think with the demand going up, maybe affordability starts to come down in the Midwest, but I think it's a good indication of forward-looking rent growth in the Midwest, where if we're some of the most affordable in the nation, we have some of the largest growing demand drivers that are coming. That equation,
And the supply is
too
coming down faster in the Midwest as well, even with the demand.
Just seems like we're kind of setting ourselves up to, get into an asset now to have what I think would potentially be above national average rent growth, which we've seen historically in the Midwest. And so I think it's just kind of the continuation of the story of the steady Eddie Midwest markets to where we're not this big boom and bust. We're drawing residents because of affordability, but we're also seeing improving number of jobs coming. So I think it's an exciting time, obviously, to be in the Midwest. We're just happy that we're from here, lucky that we're from here and we operate here. But I just thought it was interesting. Dive into this article. There's all sorts of different comparisons of how far your $1,500 go.
It's cool. Again, got to get signed up for the Gray Report newsletter, graycapitalllc.com. And if you go there, you can get access to the deal room. Also, check out Century. It's an opportunity that we're really excited about. Another major large co-investment from myself and my family going into the deal, investing right alongside you. And check out the deal room, schedule a meeting with Griffin. We'd love to talk to you, just figure out where you are in your investing journey and talk about what you think about multifamily and see if Century is right for you. It is only open for accredited investors. That's under duress from the SEC. They kind of force their hand there. But we'd love to have a conversation with you. It's an exciting deal. Griffin, great episode. It's good stuff. Catch you on the next week's episode where we're going to be talking about something even more exciting. So you got to subscribe to the Gray Capital YouTube channel. Then you get Katrina's Complex podcast, who's coming in to record right now. We're right on time. We got to get out of here, Griffin, because Katrina's got to get in here and do her podcast.
She does.
Thanks, guys. See you next time.